It is noontime, so thank you so much for joining today's Strategies for Successful Saving workshop. My name is Rachel McKinley. I am the Vice President of Marketing here at Maine Family FCU, and I am also a certified credit union financial counselor. So I'm here to help you learn about the different types of savings accounts that we offer and how to use those accounts to make sure that you are reaching your goals. So today's agenda, we know that saving money is not usually very easy, but having a plan can make a big difference. So today we're going to talk about why saving matters, exploring different savings options, looking at common goals that people tend to save for. And I'm going to share some simple strategies to help you build that savings plan so that you can stick with it. No matter where you are in your financial journey, there are steps that you can take to make progress toward your goals. And throughout this presentation, if you have any questions, please just drop them in the chat or the Q&A. I'm going to try to keep my eye on those things so that you can get the answers that you want as we're talking. So the first thing we're going to just talk about is just going over different savings account types. There are several types of savings accounts that serve different purposes and have different features. So we're going to start by talking about those different types and then what's available and how you can choose and how each are used. So the basic savings account is a traditional savings, or what we call a share account at a credit union. A traditional savings account, it's the most common type of savings account. It gives you a good place to set money aside while earning some interest on your balance. They're really designed for saving rather than everyday spending. So it helps you build funds for emergencies, future purposes, or other financial goals. Traditional savings accounts are a simple and effective way to start building a healthy savings habit and keep your money accessible when you need it. So here at Maine Family, a traditional savings account, like I mentioned, is called a share account. Because we are a member-owned cooperative, that share account is your membership with the credit union. You usually have to start with $5 and then you can add as much as you want, but that $5 is always held as your share of the credit union. Share accounts provide a safe place to save money while earning dividends, which is the credit union equivalent of interest on those eligible balances. Share accounts are designed to help members build savings for short and long-term goals while keeping your funds accessible when it's needed. Members can access their share accounts through online and mobile banking. You can transfer between accounts. So if you have a checking account or another share account, you can transfer between those on online banking. You can do some ATM transactions if you have a debit card that's connected to your checking account, or if you have an ATM card for your share account, or you can visit a branch to withdraw funds. Like most savings accounts, share accounts are intended for saving rather than everyday spending. So if you want to prepare for the holidays, taxes, a vacation, or a special purchase, club accounts are a really good way to put aside money you need. You can either use payroll deduction or automatically transfer your deposit funds throughout the year to help you save. These accounts are typically set up to accept contributions for a set time frame, and then they release the funds to you at the end of a period. So that's what makes it a little bit different than a regular share account. So we offer 3 different types of club accounts at Maine Family. We offer holiday club accounts, vacation clubs, and tax clubs. So holiday club obviously helps you prepare for the holidays. It's very expensive to make purchases around the holiday time, so it's a really good idea to open a holiday club at the beginning of the year, and then you can make regular deposits throughout the year. On October 1st or whenever you choose, that balance is automatically transferred to your savings or your checking account, which gives you the money that you need to make your holiday purchases. Makes it a little more stress-free holiday season. A vacation club account for vacations. Obviously, if you're dreaming of going to the Caribbean or to Europe, a vacation club account makes it really easy for you to save your travel expenses little by little. So you can build your vacation fund through the year, and then your balance can be transferred whenever you're ready to book your trip, helping you make that, enjoy your vacation without any financial stress. And then finally, a tax savings account is geared for tax season. Obviously, taxes can be expensive, especially if you're self-employed and you expect to owe money when you're filing. So a dedicated tax savings account will help you set aside funds throughout the year so you're better prepared when tax payments are due. Saving a little bit of money at a time will help make your April tax filing a lot less stressful. All right. So one of the special account types that we have here at Main Family is the Changes Good Roundup Savings Account. This is a way for you to use your debit card to make your regular purchases, which you're probably doing anyway if you have a checking account. And it rounds your purchase up to the nearest dollar and deposits that spare change into a special savings account. The benefit of this is that it makes your savings simple and effortless. Every time you make a purchase that you were already doing anyway, you have a little bit that's deposited in an account. It doesn't mean anything that you need to remember to do a transfer for. It's effortless. So those small amounts, they may be like if you have a $5.50 transaction, that additional 50 cents will be added to your Changes Good account. And over time, that really can add up to a lot. The best part about this account is that it pays a high yield on balances up to $500. So it's really meant to help people build an emergency savings because there is a shocking number of people in America who cannot cover a $400 emergency. So this account is a really, really good way to help you build that emergency savings to cover, a $400 emergency. Say you're driving to work and the tire in your car blows, and that's a couple $100 right there. And if you're not planning for it, it can really be an impact to your budget. So this is a really good way for you to build that emergency savings and have a little cushion for those unexpected events. And the interest rate helps build those savings even faster. So those small amounts that are, 25 cents, 50 cents, whatever it is, build up even faster. The next account type we have is a share certificate, which at banks are usually known as certificates of deposit or CDs. Same thing, just a different term. So with a share certificate, you're going to deposit a specific amount of money for a specific time. So we offer different time frames for those, and you get a higher interest rate than you normally would on your regular share account. Because you're basically using those funds and you're agreeing to let us use those funds for a loan. That's why we offer you that higher interest rate. But you'll still get it back. The downside with a share certificate is that your access to the funds may be limited. And if you need to withdraw them before your certificate matures, you may have to pay an early withdrawal fee. So the key with share accounts, the minimum to open any share certificate here at Main Family is $500. Our terms go anywhere from 6 months to 60 months. And those dividends that you earn are accrued daily and compounded monthly. So you have a choice where your dividends are to be distributed. You can have them distributed back to your certificate, so you're continuing to build that balance and earn more. Or you can have it go to another account, or you can have it as a check. The next type is a money market account, which is actually really similar to both a savings and a checking account, or a share account and a checking account. You still have liquid access to your funds. It's not like a CD or a certificate where your funds are tied up for a certain period of time. You have access to them, but because they're really not meant as transactional accounts, you actually earn a higher interest rate than you would on your checking or your share account. And you can actually use a debit card to make purchases with these money markets. So even though it has a higher interest rate, there are a little bit of limitations. There is a minimum balance requirement to open or minimum deposit required to open the account, and a minimum balance requirement needed to earn the interest rate. A money market is really a good option for people who've accumulated some savings already, but they still want to keep their money available when they need it instead of tying it up in a certificate. Since we've already talked about traditional money markets, I actually want to draw your attention to another account that we offer that helps members build their savings. A lot of times people assume that you need a large amount of money to open a money market. Here we know that that's not the case for everybody, so we have built a mini money market product, which actually is geared to smaller amounts, and it helps people with those smaller amounts build their savings faster. It allows you to, the mini money market actually allows you to earn money or earn dividends up to $2,500. So it's a 3.66% annual percentage yield on that first $2,500, whereas a regular money market, you don't start earning the higher dividends until you reach the $2,500 amount. This is a really good way, again, if you have a little bit of money you can set aside and then you can continue adding to it over time, it can really build up much faster because you are earning a really decent yield. It's a great option if you're looking to build an emergency fund, or if you're looking at building a larger savings, a savings goal. Say you want to buy a house, or you need to save up to have put a down payment on a new vehicle. This is a really great way for you to do that and have it happen a lot faster because you're earning more on that money, but you're still keeping it accessible if you need it. So the last couple of accounts we're going to cover are a little bit different because they're very specific types of accounts and they have some restrictions and considerations. I'm not going to go into a lot of detail, but I do want to just touch on these because they are important if you're saving for specific purposes. A health savings account is the first account that I wanted to cover. This allows you to set money aside for specific medical expenses because we all know even with insurance, medical expenses are extremely high. A health savings account, if you have a high deductible healthcare plan, is a good way to set money aside to cover some of those bills that you may receive before you reach your deductible. Some employers offer a health savings account as part of their healthcare plan. If not, Maine Family does offer a health savings account. There's usually limitations on who can open a health savings account based on the type of insurance policy you have, which is a high deductible healthcare plan. And there's usually limits on how much you can contribute to your HSA annually. And then it is restricted on what you can use the funds for. It has to be a qualified medical expense. And there are some tax considerations. So if you do use this account to make a non-healthcare purchase, there is a possibility that you will be taxed on those funds because these are usually pre-tax dollars. So you can deposit money into this account before your taxes are taken out, which helps reduce your tax liability as well. Of course, if you don't have a high deductible healthcare plan, you can also just create your own account, a separate savings account, and use that for healthcare expenses to avoid the deposit limitations and the limitations on what you can use it for. But if you're going to have an HSA, you really need to make sure you're following those guidelines. So Maine Family's HSA has a no minimum balance required. That means you can start saving at whatever amount fits your budget. Those funds can be used for eligible healthcare expenses such as deductibles, co-pays, and other out-of-pocket medical costs. That gives you the flexibility to be able to cover those healthcare needs when they arise. Another unique feature of an HSA is that the account belongs to you. So if you change jobs, if you retire, or you switch healthcare plans, that account stays with you. In the event of a spouse inheriting the account, it can actually transfer tax-free. So there is a lot of benefits to this. So you really want to think of an HSA as a dedicated emergency fund for healthcare expenses. and then it offers potential tax advantages and stays with you throughout your life. So even those small regular contributions can really help you build a financial cushion for your future medical costs. And if you have any questions about the tax liabilities, I would really recommend consulting a tax professional. We are not tax professionals here. So if you have questions about those, definitely consult a tax professional if you're looking at like what kinds of purchases you can make or how much you can deposit or how it is transferred. So the final type of savings we're going to discuss is retirement savings. Obviously, these accounts are designed to help you set money aside now so you can support your lifestyle and your financial needs as you hit retirement. Unlike traditional savings accounts, retirement accounts are typically investment-based, which means your money has the potential to grow over time through compound earnings. So the earlier you start saving, the more time your money has to work for you. Really, you want to think of retirement savings as paying your future self. Every dollar you save today is an investment in the life you want to live tomorrow. So while sometimes retirement may be far off and it's hard to really visualize that, even small amounts are going to make a huge difference over time. Checking the chat and the Q&A, making sure we're all set here. More on retirement accounts. So a common retirement account offered by an employer is a 401k or a 401 or 403b if you work for a nonprofit. Those contributions are typically deducted automatically from your paycheck, which is really nice because you don't see it coming out, and it can come out before taxes depending on the type of account you have. And a lot of employers offer a matching contribution, which means they add the money to your account based on how much you can contribute. This is something that if your employer offers matching funds, I would strongly recommend putting in at least that same amount. So if your employer offers 5% match, you should definitely be putting in at least 5% of your annual pay to get the entire match. So essentially you're getting 10%. If you don't, it's like leaving money on the table. These plans are usually investment plans, and the investments are usually selected by your employer. You have a little bit of a choice. They're usually target funds, mutual funds, and a lot of them are target dates. So if you know you're going to turn 65 in 2045, you would probably want to choose a target date fund that's more geared toward that. But your investment professional would be a very good source of the information on what you should choose. So your 401k will stay with you, but you need to figure out what to do with it after your job. Do you leave it there? Do you roll it into another 401k? Again, consult with your investment professional to figure out what the best option is for you. So another type of retirement savings account is an individual retirement account, or an IRA. And it's a retirement account that you open and manage yourself through your financial institution. So you can open an IRA whether or not your employer offers a retirement plan. Some of the key differences of an IRA are that you get to choose where to open the account and how to invest your funds, but the contribution limits are lower than those for a 401k. If you don't have access to a workplace retirement plan, or if you actually just want to save more than you do in your 401k, if you want to exceed those limits because maybe you're getting closer to retirement, or you just are really strong looking to invest to maybe retire early, having an IRA is a great option because it gives you the ability to save even more. There are two different types of individual retirement accounts. There are traditional IRAs and Roth IRAs. So the biggest difference between those two is when you pay the taxes. With a traditional IRA, the contributions are made with pre-tax dollars, so that can reduce your taxable income today. Those investments will grow tax deferred, and then you'll pay taxes when you withdraw the money. With a Roth IRA, the contributions are made with the money that has already been taxed. So in exchange for those investments, they grow tax-free. And when you make qualified withdrawals at retirement age, which right now is 59 and a half, they are also generally withdrawn tax-free. So now that we've talked a little bit about the different types of savings accounts, let's move into talking a little bit more about different categories that you might want to save for. First thing that we want to discuss, and this is the really important piece, is having an emergency fund, which is money you set aside specifically for unexpected, unavoidable expenses. So those two words are super important: unexpected and unavoidable. An emergency is not something that you saw coming, and it's not something that you can put off. So for example, your car breaks down and you need to get to work, that's definitely an emergency expense. A surprise medical bill or a home repair would also fall into this category. Your furnace going out or your septic tank leaking, those are really expensive and very emergent needs that you're going to want to fix immediately. So having an emergency savings account is a really good way to not have to take on additional debt or to have to scramble and ruin your budget for that month. So on the other hand, an unexpected deal on flights to Europe may be super exciting, but it's definitely not an emergency. While it may be a great opportunity, it's not something that is essential that requires immediate financial attention. So when you're deciding whether to use your emergency savings, you should ask yourself, is this expense both unexpected and unavoidable? If the answer is yes, that's exactly what your emergency fund is designed for. The nature of emergency that is that it's unexpected. So it's really important to keep that money in your emergency fund accessible so you can get the money easily when needed. So it's probably not best to put it in a certificate. So the age-old question when it comes to emergency fund is, how much do I need to save? That's going to depend on your individual situation. A lot of times you hear advice like saving 3 to 6 months of your expenses it's a great goal, but it's really not always feasible for people. It may take years to achieve that amount. Start out by looking at how much your household needs to feel secure. It might be a $500 cushion to know that, like, if your car needs repairs, you have the money to cover it. $500 is still a great emergency savings. Maybe it's your insurance deductible. So if you have a $500 insurance deductible and you get in an accident, you don't have to worry about covering that deductible if you have your $500 emergency savings account. Maybe you want to be able to just cover your rent payment if something happens and you're not able to work for a while. There's no right or wrong answer for this. It's definitely dependent on what your situation is and what you feel like you can comfortably afford to save on a regular basis. And then you just keep building it and it keeps growing. And of course, wouldn't it be nice that if it were just one unexpected expense that we had for the rest of our lives, and then you don't have to worry about it anymore? Clearly, it's not going to be the issue. Expenses come up all the time that we aren't expecting. So your emergency fund is something that is really ongoing. You're going to make withdrawals from it, and you just need to keep rebuilding it. As you reach your smaller emergency fund goals, it's really helpful to have to remember that you have tucked away for those unexpected expenses, the better. So I really encourage you to not think of your emergency fund as ever full. Really prioritize building that fund, even if it's, $5 a week. Every little bit adds up. I'm gonna switch gears here a little bit. Saving for goals is probably a lot more fun than saving for emergencies. Obviously, you're going to prioritize that emergency fund because you don't know what's going to happen. But there are some times where you want to save for a specific goal and you want to set aside that money for something maybe more fun. You can have a short-term savings goal, such as setting aside money for a vacation a few months from now, or medium term, like saving for a down payment for a home over the next few years. And then some goals may be long-term that require years or even decades of planning and saving. Usually it's building your retirement fund. So that timeline that you have for your goals will help you determine how much you need to save and what makes the most sense where it makes the most sense to keep your money. The sooner you identify that goal, the more time you have to save for it. So if you know, say next year you want to go on vacation, start saving now. Put aside a few dollars a week. It will all add up in the long run. If you're saving for a long-term goal and you won't need that money for a while, I would consider putting those funds into an account that may offer you a higher interest rate, but it might limit the access to the funds. So you're actually less likely to dip into that before you reach your goal. So that's where a certificate might come in handy because you're earning a higher interest rate and it's harder to just take any money from it because something else has come up, or you find, maybe you find those great flights to Europe and you're like, oh, I want to do that. That way, this doesn't, it takes away the temptation to take away from those savings funds. Of course, if something comes up and you really need it, that money, you can definitely borrow it. But the idea here is really to try and earn more interest while you're reducing the access to your funds that you're tucking away for these longer term goals. Most of us have more than one goal that we're saving toward at once. And maybe we're saving for vacation in 6 months and we're saving for a down payment in a couple years. And that's great. Saving for goals is not an either or situation. I would encourage you to think about considering keeping those funds separate by maybe using different share accounts or sub accounts to split the funds up. That helps that you ensure you stay on track for your goals, and then you keep your money separated so you know how much you have available for each of those goals. Just checking the Q&A and make sure there's nothing in here. I don't want to miss any questions. And your final saving purpose that we're going to talk about today is what's referred to as a sinking fund. So a sinking fund is putting away money to cover periodic expenses that you know are coming. So when I say periodic expenses, I mean that you're only paying them a few times a year, maybe once a year, not a monthly expense. When those expenses come up, they can be really challenging to account for in your monthly budget. So even if you know they're coming, it can be a little hard. Your seeking funds are a way to set aside a little bit of money every month so that when those periodic expenses arise, you're ready to cover them without derailing your entire budget for the month. So maybe it's your vehicle registration, or if you pay insurance every 6 months, that premium comes due. That could be a lot of money. So a sinking funds account is a really good way to make sure that you're ready to cover those. Sinking funds are different than emergency funds because they're for things that we know are coming. So birthdays and anniversaries that are on the same date every year, holidays that roll around the end of every year. Maybe you have a child that summer camp registration is due every May. Sinking funds can also be created for expenses that you may not know the exact date for, but you know that can come up at some point, like car or home maintenance or activity expenses for the kiddos. Emergency funds are for things that come out of the blue and cannot really be planned for in advance because nobody expects to get into a car accident, nobody expects to lose their job, or nobody expects to receive a medical diagnosis. Sinking funds are for those expenses that are maybe less frequent, but they're still things that we know we're going to be paying for. Similarly to your goals, you're encouraged to have multiple sinking funds if you have multiple periodic expenses that you want to be prepared for. So before we go any further, I'm just going to walk through some example scenarios and talk about which savings category each expense would fall under. So this is the time where you can start just answering in the chat. The first question I have is, so back to school shopping, which is coming up really soon. Is this something that you would use an emergency fund for, goal savings, or a sinking fund? Correct. It is a sinking fund. School supplies and new shoes and new clothes every year are not cheap, but we know it's something that's going to happen because school year rolls around every year. It's a prime example of something that you can plan ahead for and use a sinking fund so you're not derailing your entire budget to pay for all of those new things every August. The next one, a tree falls on your roof. Is this an emergency fund, a goal fund, or a sinking fund? Emergency fund is correct. It is definitely an emergency because nobody ever expects a tree to fall on their roof. This is a prime example of why you would want to use your emergency fund. Holiday gifts and the tradition of traveling to see your grandparents every December. Do you consider that emergency, goal, or sinking? Sinking fund is correct. This is an annual tradition. You know that you're going to prioritize it every December, so it's definitely a prime example of a sinking fund. So what about a big family vacation next summer? Is that an emergency fund, goal savings, or a sinking fund? All right, goal savings, you have got this. It could potentially be a sinking fund for some people, but I think really for most people, it's a goal that we're saving for. A down payment for a new house, is this emergency fund, a goal fund, or a sinking fund? So this one is a goal savings because it is a longer term goal that we are saving towards. What about new brakes for your car? So yes, it could, this one depends. New brakes may catch you off guard and it may be an emergency, especially if your car won't pass inspection. However, if you know that your car is getting older, you should definitely have a sinking fund for vehicle maintenance. And as somebody who drives an older car, I definitely have that because sometimes when I bring it in, it takes you by surprise a little bit how much all of that costs. So what about a car repair after getting into an accident? Is that emergency, goal, or sinking? Also emergency fund. Definitely. You can't plan for a car accident. So you definitely want emergency savings for this, even if it's just to cover your insurance deductible. So final example, and you're doing a great job. I appreciate the interaction. What about your annual insurance payment? Maybe you have car insurance, homeowners insurance, life insurance, a premium, that's due once a year, maybe even every 6 months. Where would this fall? Emergency, goal, or sinking? Sinking fund. All right, very good. It is a really good example that it's coming, but it's not something that you have to pay for every month. So obviously you've got these down pat, which I really appreciate. So thank you for that. Now that we've talked about where you're saving money and what to save for, I'm just going to wrap up on how to build a savings plan. So really a savings plan is a nice word for a budget because nobody really likes to say budget. It just doesn't sound as exciting, but a savings plan sounds like an action-based thing that you're going to do, and it's like you have a goal. So I really like using the word savings or the term savings plan versus using budget. The first step is to create your monthly budget. We're using that word, but you just need to know how much money you have available to put toward your various savings accounts. And that budget worksheet is really important on how you're going to figure that out. So you're going to list all of your reliable income, whether you have a regular full-time job, part-time job, something that you're getting regular income from. And then you review all of your statements to identify all of your expenses. This is where it might get tricky because sometimes there's those expenses that you forget about. So really make sure that you do a deep dive and catch all of those expenses so that you're not caught off guard and it just throws your whole savings plan off. To calculate how much money you have left after you have determined your income and then your expenses and how much you have left to put into the savings after all of those priority expenses are covered. So after we finish this workshop by tomorrow, I am going to send you an entire budget worksheet and also aligning priorities workbook that's going to help you walk through this entire process. It's a little hard to do, probably easier to do if we were doing this in person, but those workbooks will really help you go through all of your funds and see where you can put your savings aside. So next, you're going to want to determine what you want to save for. Do you want to start with an emergency fund? Do you have any short and long-term financial goals that you have? So what are those expenses that you're paying periodically throughout the year that sometimes might surprise you? Or maybe you just feel like you're stressed every time those expenses come around. How can you help reduce the stress that you're feeling when you have those expenses? So a little, some of the example of sinking funds that you might want to create for holidays, birthdays, and anniversaries. They come every year. We really can't avoid them. Car maintenance, again, even for newer cars, there's always, even just oil changes, brakes, tires, those things can all really add up. Home maintenance, again, cleaning your furnace. Maybe oil, that would be a definite sinking fund that you're not paying for all the time, or, oil or natural gas. But especially with prices where they are now, it is expensive. So you really want to plan ahead for that. Medical and dental expenses or vet bills, which as somebody with quite a few animals, vet bills can get really unwieldy. So having a specific sinking fund for those is a really good idea. Again, school expenses or kids' activities are another sinking fund, and then insurances and taxes. We know these all are going to be coming up and we're going to have to pay them. So if you start just putting aside a little bit throughout the year, it helps you reduce the amount of stress on your budget because you're not having to come up with all of that money at once. So for goal savings, some of the goals that you may have is for a vacation or a home remodeling project, a new vehicle, a down payment on a new home or an investment property, or maybe you're looking at moving. These are all things that you're planning for, and that's a goal that you really want to save for. So they may be, some of those may be short term, some of them may be longer term, and it may take you a few years to get to that point. But again, the steady, regular savings will help you reach those goals. So now you really want to go back to the amount of money that your budget or your savings plan can support going to savings each month. How do you want to break that number down? Are there some specific goals or sinking funds that have a deadline so that you make those a higher priority? Are you really focused on making sure that you build your emergency fund to save $500 to meet your insurance deductible? That's individually determined, but just make sure that you know first what those goals are before you start breaking it all down. So this is just an example on the different ways that you might want to look at saving. This is a person that maybe doesn't exist, but this is just a little example from them. And this is all the things that they want to save for each year and how much they want to save. So they divided those annual amounts by 12 to determine how much they needed to save every month to get to those goals. So if you have $400 available in your budget for all of this, great. If not, you'll have to go back to the drawing board and kind of reprioritize and determine if there's any room for flexibility on expenses, like maybe there's some streaming services you can cut out, maybe some Dunkin' runs that you can avoid and make some coffee at home. These are, and you may also want to look for other opportunities to bring more income. Maybe you want to get a side gig. That might help you build those savings accounts a little bit faster. So once you've determined all of your savings categories and how much you plan to save for each, it's time to set up your accounts. Consider which of the different account types we talked about earlier that make the most sense. Maybe there's a club savings account that could align with one of your sinking funds. So if you're looking at going on vacation, a vacation club would be a good match for that. Or you know that you're self-employed and you have taxes due quarterly. A tax club could help you make sure that you are ready when those quarterly taxes come around. So you want to determine if you want to keep this money separate. Do you want to open entirely separate accounts for each purpose, or do you want to have do you have the ability to break up your accounts into buckets that kind of they let you keep your money in one account, but you can account for it separately. It's good to explore your options, but you definitely want to be able to distinguish what money you're saving for what purpose. So remember to look into options that have a higher interest rate if you're not planning to touch the funds that you're saving for a while. That's really where you're going to want to look at your certificates or maybe a money market. Next up, this is the fun part. If you can deposit money into your savings automatically, it is much less stressful. Kind of make it part of your savings plan where you know X number of dollars is going into your savings account every week or every time you receive a paycheck. And you don't really have to think about it. Same thing with your retirement fund. If you are taking payroll deduction for it, it's automatically taken out. You don't even see that it's coming out, and you know that it is there earning interest and building so that you can retire comfortably. It's each person is different. What you are able to save is going to differ, but if you can make it automatic, it is much easier for you to stay on track with your goals. So like the adage is like paying yourself first. So putting money in your savings first before you start using that money for something else. Because if you don't pay yourself first, it's very unlikely you're going to have any left over at the end of the month to actually put into your savings. So finally, you can sit back and watch those savings accounts grow. And then if there's a need that arises, so like, an emergency expense, you need a new tire, you need new brakes, or one of those periodic expenses, you don't have to be afraid to use those funds. That's what they're for. So saving is an ongoing cycle. We save the money, we use the funds, and then we save again. So before we finish, there's just a couple of bonus steps for you to keep in mind as well. If you get extra money that you were not expecting, so like a tax refund or a bonus, or maybe you have a side hustle or an inheritance, whatever that is, it's really important that you consider putting that money into savings. It's very tempting to go ahead and use like, oh, I've been wanting this item, and you want to go use that bonus. It's super tempting. But if you think about your future self, this is where you can benefit by putting that money aside and letting it earn interest, because it helps you build those funds much faster. So maybe you can use that money to fill up a couple of your sinking funds for the year, and then you can redirect those deposits that you were planning on putting the sinking funds into, and then you can put those into your emergency savings or a goal savings or something else like paying your debt down. And it helps you reduce the amount that you owe and reduce the amount of interest that you're paying on your debt. Maybe you want to put your funds straight toward the goal you're saving for or the emergency fund. Be strategic, because that extra money can be a great tool to help you accomplish some of those savings targets. And finally, you don't have to figure this all out alone. If you're really excited about the idea of saving, but you're struggling to figure out how to make it work in your budget, you're definitely not alone. It's not easy. We partner with a nonprofit called Green Path Financial Wellness. They provide free resources to our members to help with budgeting, college savings, student loans, housing, all of these things that you need to live a financially healthy life. We also, if you want, you can also reach out to me directly. The email will be, you can reply to the email that I'm going to send after this webinar, and you can set up a time with me if you'd like, and we can work directly together. Or you can work with Green Path. Like I said, it's at no cost to you, and it's completely confidential. So if that's more comfortable for you, the nice thing is they are open a little bit later hours. They have people throughout the country. So they have people who are working on Pacific time that maybe can meet you after work. They can talk on the phone, meet with you virtually via Zoom. It's a really flexible option that you can use. And I really encourage you to lean on our Green Path partners, because they are truly amazing. They can go through and do a complete confidential financial assessment with you, and can look at your budget and your savings plan. And they can work on developing an action plan for you to help you reach those financial goals. They can also talk about other things, like if you are worried about credit or housing or student loans or debt, they also have experts in all of those that can help you reach those goals or pay down debt or whatever it is you need. You can call them at any time at 877-337-3399, or you can visit our website at mainfamilyfcu.com/greenpath, and then there's a link on there that goes to their website. They also have some really fun tools. They have some courses, like these Learning Lab courses that you can take if you're really interested in learning more about your own financial wellness. I encourage you to do those things because it just gives you a broader knowledge and makes you feel a lot more confident. I think the more you know, the more confident you feel, and the better off you'll be able to save and actually stick with that savings plan. So that is all I have today. My thank you slide is missing, and I apologize for that. But I really appreciate your participation in this webinar today. It's always fun to have some of those little interactive quizzes. Do you have any questions before we hop off? Perfect. Well, I'm glad that you found this useful. I really appreciate your time. Again, if you want to schedule something with GreenPath, please go ahead and contact them directly. If you would prefer to do it in person, you can respond to the email that will be going out within the next 24 hours. Again, it's going to have the whole budgeting worksheet. There was a workbook that's going to be included in that, and I'll send the links for GreenPath in that email, just so you know. And I will also send a link for our future webinars. We have one every month. Usually it's at noontime, which I know is not always easy for people to attend, but the nice thing is that they're all recorded, and I do put them on YouTube afterwards, so that if you want to go and rewatch it, if you want to see some of our previous webinars, or if you want to share it with somebody, it's all on our YouTube channel. So we've done webinars so far on fraud and identity theft. We've talked about understanding credit. We've talked about the debt management program that GreenPath offers. Youth savings, when we did that during Youth Month. So we have a variety of different topics that we're trying to cover. Last month, we actually did a teen savings, trying to understand how like when you have that first job, how you can start saving. So if there's anything that you would like to see, we are definitely open to suggestions. We would love to cater a specific webinar to specific needs if there are things. So again, go ahead and respond to that email. And that's all I have for today. So I appreciate it. Thank you so much, and enjoy the rest of your day as well.